Imagine waking up one morning to a world turned upside down. That heirloom silverware in your grandmother's cabinet. It's not just a memory anymore. It's suddenly worth more than her house. Not by a little, but by a staggering amount. Across the financial world, chaos erupts. Portfolios that overlooked this humble metal are bleeding red. Seasoned traders who bet against its rise are facing margin calls, scrambling to cover their losses. And on the streets, a modern-day gold rush is underway, with long queues snaking outside mints and bullion shops full of people desperate to get their hands on physical silver before it's all gone. What if I told you this isn't a scene from a Hollywood movie? It's the reality unfolding in financial markets right now. In a matter of weeks, silver has surged over 30%, shattering multi-year highs and outperforming nearly every other asset class. Silver-backed ETFs are witnessing unprecedented inflows, absorbing millions of ounces of physical metal daily. The demand is so intense that parts of the market are flashing warning signs and analysts are whispering one electrifying and terrifying word: bubble. But is it that simple? In this deep dive, we're going beyond the headlines. By the end of this video, you'll understand exactly why silver exploded, which forces are fundamental and structural and which are purely speculative froth. We'll map out the most likely scenarios for what comes next, from a catastrophic bubble pop to a calmer, sustained revaluation that establishes a new floor for the metal's price. We're decoding the entire system, how money rotates between assets, how market psychology can create bubbles out of thin air, and what silver's dramatic run truly signals about the health of the global economy. We'll explore the stories, dissect the data, and most importantly, we will tackle the big question on every investor's mind. Is this a once-in-a-generation buying opportunity driven by a structural supply deficit or a speculative frenzy on the verge of collapse? Quick reset. Let's continue. A brief visual interlude to refocus before we dive deeper. This isn't just about shiny coins or old-world treasure. Silver is a unique hybrid, both an industrial metal and a monetary metal. It sits at the critical crossroads of technology, investment, and human psychology. Its dual nature means that when silver moves dramatically, it doesn't just make headlines. It affects the global economy in very real ways. Think about its role in modern life. As the most conductive element, it's irreplaceable in electronics, from the smartphone in your pocket to the servers, powering the cloud. In the green energy transition, every electric vehicle and solar panel relies on it. Even in medicine, its natural antimicrobial properties are vital for everything from surgical tools to advanced wound care. This isn't a niche material, it's a foundational one. So when a price shock hits, manufacturers scramble for supply, investors rewire entire portfolios, and retail buyers react emotionally, fueling even more price momentum. Today's rally is driven by a perfect storm of macro policies, persistent supply tightness, surging industrial demand, and a torrent of speculative flows. So what actually happened? In early October 2025, silver blasted through its previous all-time highs, touching the low 50s per ounce, levels unseen in modern history. Headlines screamed, physical demand spiked, ETFs recorded record inflows, short-covering traders tightened markets further, creating conditions not seen in decades. The Silver Institute's 2025 survey confirmed the story. Demand was structurally outpacing mine output and recycled supply. These weren't paper deficits. They were real-world shortages meeting a tidal wave of speculative demand. This is the perfect storm. When fundamentals and speculation finally align, markets don't just move fast, they move brutally. Here's our roadmap today. 1. What pushed money into silver? 2. Why real-world demand keeps pulling it higher. 3. Why supply can't keep up. 4. The speculative overflow and short squeeze. 5. Lessons from 1980 and 2011. 6. What could happen next. 7. What it means for you. Let's start with the macro forces. Transition montage. Markets breathe between beats. Stay with me as we pivot from roadmap to the macro engines driving silver. The stage was set by a powerful macroeconomic shift. When interest rates start to fall, non-yielding assets like silver, which don't pay dividends or interest, suddenly shine much brighter. The market began pricing in rate cuts for 2025, making holding cash less attractive. This expectation, combined with persistent global uncertainty, sent investors hunting for the perceived safety of hard assets. Gold, the traditional safe haven, led the charge. But silver, its more volatile cousin, followed faster and harder. A key catalyst was the weakening US dollar. As the dollar index, or DXY, trended downwards, it acted like a tailwind, lifting all commodities priced in dollars. But silver's relatively small market size magnified this effect dramatically. Unlike the vast gold market, even small capital inflows into silver could trigger outsized price reactions, creating a high beta play on dollar weakness. At the same time, leading economic indicators, like the Purchasing Managers' Index, began flashing warning signs of a slowdown. Weakening manufacturing activity signaled trouble ahead, further fueling the flight to safety. Meanwhile, inflation worries persisted. Even as official data cooled, the public feared a sticky inflation that would erode their savings over time. This fear made tangible assets feel essential again. And then came the rotation, the great asset shift. After years of chasing high-flying tech and growth stocks, institutional money started looking for undervalued and defensive plays. Once these large funds began reallocating to value and safety, momentum traders followed, amplifying the trend. Soon, the retail crowd joined in. You've probably seen it yourself. Social media feeds suddenly filled with buy silver posts and viral videos of newly acquired coins. This is the modern face of market sentiment, a digital signal that a rotation is gaining popular momentum, often just before it approaches mania. Short consolidation after the breakout, momentum gathering. Let's keep tracking how flows and positioning shape price action. Now the pull factors, real-world demand. Silver isn't just stored in vaults, it's consumed. Electronics, solar panels, EVs, medical devices, silver runs through them all. Unlike gold, silver gets used and rarely fully recovered. The green revolution made this even bigger. Solar panels are silver-hungry. Even though manufacturers try to use less silver per panel, the total number of panels keeps rising. Global solar demand has been one of the most powerful forces tightening this market. Then add EVs and 5G technology. Each new innovation adds another small but meaningful pull on silver supply. Macro close-ups to anchor the story, coins to kilobars. From retail counters to vaults, demand meets finite supply. Now the supply story, and why miners can't catch up. Most silver doesn't come from silver-only mines. It's a byproduct of copper, lead, and zinc mining. That makes supply slow and unresponsive. If copper miners aren't expanding, silver output doesn't rise either. Opening new mines takes years of permits, billions of dollars, and political will. Recycling helps, but even at high prices, it's limited. By 2025, the Silver Institute confirmed what traders already felt: another year of market deficit. Real shortage, not just hype. That means when demand spikes, there's no quick fix. Supply simply can't react fast enough. Quick studio bridge, reset the frame. Next, why supply lags even when prices scream higher. Now the speculative side, the gasoline poured on an already hot fire. ETFs like SLV became the engine of modern silver demand. When investors buy ETF shares, the trust must purchase physical silver and store it. That drives visible demand spikes. In 2025, SLV's holdings exploded. Soon, borrowing ETF shares became expensive. Short sellers were squeezed. Hard-to-borrow lists grew. Physical metal was harder to source. Paper contracts began to diverge from spot prices. That's what traders call dislocation. When short sellers rush to cover, they buy, pushing prices up even more. The feedback loop becomes self-feeding. Meanwhile, social media amplified it all. Short squeeze silver hashtags spread like wildfire. Retail traders piled in, convinced they were fighting big institutions. Coin shops ran out of stock. Premiums soared. Dealers couldn't get enough supply. That's when a financial movement becomes a human story. SLV on screen. Holdings swelling with inflows. Watch the ticker. It mirrors investor appetite in real time. It's not the first time. In 1980, the Hunt brothers famously tried to corner the silver market. Prices exploded, then collapsed overnight when margin rules changed. Fortunes vanished. The lesson: leverage and concentration can create bubbles that burst brutally. In 2011, silver soared again after the financial crisis. Investors feared inflation and currency collapse. But once the panic faded, silver fell hard. So, what's different now? Unlike 1980 or 2011, today's rally sits on real industrial foundations, solar, electronics, and limited mine supply. Yet, speculation has layered itself on top, making the move sharper and riskier. Solar panels, quiet workhorses of demand. This silent engine keeps pulling silver into industry. Let's look closer at SLV, the epicenter of the silver storm. As demand surged, SLV had to add physical ounces daily. Inventories ballooned. The ETF's own mechanics turned it into a public indicator of investor appetite. Borrowing SLV shares became costly. Traders trying to short-faced rising fees. The more they paid, the more painful it became to stay short. Many covered. Prices jumped again. Soon, spot silver traded above futures, meaning people were desperate for immediate delivery. That's a textbook sign of a market under stress. The modern ETF system made silver more accessible, but also more volatile. It turned a slow-moving commodity into a real-time speculative vehicle. Now let's talk psychology, because bubbles are built on stories, not just numbers. The green metal story, silver as the metal of the clean future. It's partly true, but when it becomes religion, it can only go up. That's when trouble starts. The inflation hedge story, silver as the poor man's gold. It's appealing. It makes people believe they're buying safety, even when they're chasing risk. And the short squeeze story, the rebellion of the retail investor. It gives emotional meaning to a trade, a sense of battle. But markets don't care about stories. When liquidity runs dry, even heroes get crushed. Narratives are the wind that lifts dust. They look powerful until the wind stops. So what's next? 4 possible futures. Scenario 1, the soft re-rate. Silver cools off, drops 20-30% from highs and stabilizes. Prices stay elevated compared to past years. Deficits persist, a calm plateau. This happens if central banks tighten rhetoric or the dollar strengthens. Scenario 2, the bubble and pop. Speculators overextend. A policy shock or margin call triggers a crash. Prices fall 40-60%. Painful but normal. Classic bubble burst. Scenario 3, the structural revaluation. The fundamentals stay tight. Supply can't catch up. Silver becomes a more valuable industrial asset with a permanently higher baseline price. Scenario 4, the regulated correction. Exchanges or authorities intervene. New margin rules, tighter delivery controls. Volatility subsides artificially but unpredictably. The truth? Probably a mix. Expect high volatility, sudden corrections, and a new long-term floor that's higher than before. What should you do? If you're a long-term investor, don't chase hype. Buy slowly, with discipline. Silver can be a hedge, but not your core. If you're a trader, respect volatility. Use stops. Don't bet more than you can lose. If you're a learner, follow ETF data, spot futures, spreads, and the World Silver Survey. Knowledge is your edge. Let's bust a few myths. Myth 1, silver is for conspiracy theorists. Reality, it's a vital industrial material used by tech companies worldwide. Myth 2, a price spike means permanent riches. Reality, every spike eventually retraces. Only discipline survives. Myth 3, silver always moves with gold. Reality, it often does, but its industrial demand gives it a life of its own. So, is this a bubble? The honest answer? It's both. Part of this rally is pure speculation. Hype, social media, ETF momentum. But beneath that, the real economy is quietly starving for silver, for solar panels, batteries, and industry. This rally is a hybrid, fundamental scarcity wrapped in speculative frenzy. That's what makes it so dangerous and so fascinating. Price chart pause. Context matters. Volatility is normal after violent breakouts. Structure forms before the next move. Here's the takeaway. The silver rally is a mirror of our times, half reality, half illusion. It shows how narratives, technology, and human emotion collide in markets. If you're in, be intentional. If you're watching, stay curious. And if you're learning, remember this. Every bubble begins with truth and ends when truth no longer matters. So what do you think? Is this the next great commodity bubble, or just the market catching up to reality? Share your thoughts below. I read every single one. If you found this breakdown valuable, subscribe, hit like, and stay with us. We decode the systems shaping our world, from money and markets to politics and power. Soft fade in studio, wrapping insights. One last thought before the cross-promo and end screen. Today we uncovered why silver may be entering a volatile, higher regime. But this story connects to a bigger puzzle, the same forces driving Europe's internal crisis. Watch our earlier video, Europe's House of Cards, the coming collapse of the EU. You'll see how the same economic pressures driving silver's rally are also reshaping nations and alliances. Thanks for watching. Stay curious, stay skeptical. And I'll see you in the next decode. End screen. Subscribe for deeper market decodes. Next video queued on the right. Thanks for watching.